Hello everyone and welcome to episode 70 of JustDario Cigar Time. This week we have a lot of ground to cover, from gold and silver to oil, to the latest market developments and to the unmistakable shift in how information is being weaponized across mainstream and social media. The volume of narratives being pushed non-stop from every direction with no filter is something I have genuinely never seen before. And it all has one clear intent: to move financial markets. Before we begin, don't forget to like the video, subscribe to my channel, and turn on notifications so you don't miss any future updates. The first topic I want to address today is gold. Specifically, the enormous confusion around why Turkey sold 58 tons of gold in the 2 weeks leading up to March the 20th, according to the latest available data. Before this headline hit the tape, if you remember, there were plenty of accounts on social media coming directly out of Turkey reporting how retail demand for gold and silver had spiked dramatically since the Middle East conflict began. Long queues at shops, dealers and jewelers not just running out of stock, but reporting demand levels they had never seen before in their careers. And yet, on the other side, the Turkish government was simultaneously dumping a significant chunk of its gold reserves, while its own citizens were doing the exact opposite. Isn't that a little strange? No, not if you understand the link between the two. The link is the Turkish lira collapse. The lira has been hemorrhaging value for years. Those of you who followed me since I joined social media in 2020 know I flagged this very early. I even wrote a detailed post on it more than 2 years ago, in June 2023. I won't go deep into the Turkish situation today. You will find plenty of analysis across my channels, and I'll drop the link to that post in the comments. What I want to highlight is this: Turkish government has been offloading its gold reserves to defend its fiat currency, while its own citizens are dumping that same currency because they are rapidly losing faith in it. And now, Turkey sitting so close to the center of the Middle East conflict, there is a very real risk the country could be dragged into an open confrontation with a neighboring nation. That kind of escalation, by definition, always triggers a sharp devaluation of the local currency against stronger foreign currencies. And none of this is news for those of you who follow me regularly, because just last week I stressed that the sell-off in gold, silver, and government bonds is the direct consequence of a liquidity crisis spreading across the Middle East. A crisis triggered by the conflict against Iran, capital flight, and intense pressure on local currencies that are all strictly pegged to the US dollar. When a local currency in the Arabian Peninsula is being dumped, the government needs a constant supply of dollar liquidity to maintain that peg. If those pegs break, everything breaks. So Turkey, a country sitting right at the edge of this conflict, is already showing us how this liquidity crisis is spilling well beyond the countries directly in the fire. And while Turkey's 58-ton gold dump might look limited relative to the total gold market cap, those who understand the real ratio of physical gold to paper know this: when enough physical gold moves from a seller under heavy pressure to buyers ready to grab a bargain, price impact is outsized and immediate. That explains the gold dump in the past weeks, and naturally, it cascaded straight into silver. This is how precious metals trade in the short term. Every measured shock to gold is amplified in silver through its beta, the correlation coefficient between the two. Gold gets hit, silver gets hit harder. But here is what actually matters. As I've been documenting for months, the drain of physical silver from exchange vaults continues, regardless of the price. That is a clear signal of sustained, very strong underlying demand, and it might even be intensifying, as companies will likely position themselves for the electrification push and oil diversification that this war will be forcing onto the global economy. China has been leading this charge for years, which is why industrial-grade physical silver is nearly impossible to source domestically, and they're still struggling to import it from abroad. Of course, the paper shenanigans on precious metals, especially silver, continued through all of this. When brokers and market makers saw Turkey's large gold sell orders entering the market, of course, they likely front-ran them. No surprise. That front-running amplified every move we observed. These moves won't stop until oil normalizes, and the countries facing liquidity crisis have exhausted their liquidity safe haven assets. At that point, they'll have no choice but to start liquidating riskier, harder to move assets like equities, piling further pressure on the stock market. Let me be clear, I'm always open to your thoughts. Drop a comment if you disagree or if I missed something. I'm not an oracle. I share my analysis, my reasoning, my objective thinking. But I might get things wrong because I'm a human after all. Now, another critical topic. The extraordinary use of mainstream and social media as channels for headlines that appear designed to move markets rather than inform people. At this point, it's making it genuinely harder to separate reality from the noise buried inside this ginormous pile of garbage. But here is what we can objectively observe. This strategy to influence markets is becoming less and less effective. Look at the chart. I've mapped all of President Trump's latest posts against oil price movements. The drawdown triggered by each post is getting shallower and shorter-lived with each cycle. The same diminishing return is visible across every other asset class. Yesterday, after the latest post dropped after market close, and I do wonder if it timed it after hours to avoid being accused again of giving useful insider trading tips to friends, stock futures spiked. And then, by the end of the extended trading hours, they had given back almost all of those temporary gains. None of this surprised those of you who follow me. I have been drawing the parallel to the weeks before global lockdowns outside Asia in 2020, since the very beginning. Here is exactly what I posted on March the 14th, 2 weeks ago. In 2020, traders reacted to COVID only when people around them started to get sick. In 2026, traders will react to the oil shock, already triggered and intensifying since 2 weeks ago, only when we start seeing supply shortages in their daily lives. 2 weeks later, oil shortages are spreading across Asia and are now impossible to suppress, from Australia to the Philippines, which is just declared a state of emergency, to South Korea now urging citizens to limit consumption, to massive queues in Thailand and India. Look at this page from yesterday's Times of India. On one side, petrol stations running dry. On the other hand, government officials insist there is nothing to worry about and that stocks are plentiful. What a joke. Once, twice, 1 week, 2 weeks, 3 weeks. But if you keep lying, people stop believing you. And that is exactly what's happening right now. At this point, the math is unmistakable. Everyone needs to be prepared for a massive spike in crude oil prices, and the 2026 oil shock is going to be remembered as the moment markets could no longer look away, as I already warned many days ago. Here is the full picture. Global oil demand sits at roughly 105 million barrels per day. The Strait of Hormuz shutdown has pulled 20 million of those barrels straight out of supply. Refineries across the region are backed up because oil isn't flowing out, causing an additional 8 million barrels per day of disruptions from deposits. Damaged refineries account for a further 1.4 million barrels per day of production. That, even if everything normalized tomorrow, won't come back online for years. On the other side, even when large SPR release figures are announced. The actual deliverable flow is capped at 2 million barrels per day, because that's what the physical distribution network allows. You can say you're releasing 100 billion barrels from the SPR. It doesn't matter. The pipes are not going to get bigger with the number. The flow has a hard physical ceiling. Push beyond it, and the pipe explodes. And that will be an entirely different kind of mess. Saudi Arabia is already routing oil through its east-to-west pipeline at maximum capacity, 3 million additional barrels being diverted away from Hormuz. What remains of the oil already in transit before the shutdown adds roughly 2 million barrels per day. Net result, 24 million barrel per day oil shortage in the global market, persisting for nearly a month now. This is an unprecedented supply shock, with one key difference from 2020. This time, demand is not collapsing, even more because of lockdowns. Traders are beginning to price this in, but slowly, because free market price discovery is being actively suppressed. First, by the relentless media narrative I described. Second, by direct government market intervention. The US hasn't officially acknowledged it, but the fingerprints are growing harder to ignore. Japan, however, has gone further and made it official. The Japanese government has announced it will use the US Treasury resources to actively short oil futures in the open market in order to artificially keep prices low. Let me be clear about what that means. A sovereign government is using foreign reserves assets to bet against the very commodity that powers the global economy. The level of institutional insanity we reached with that move deserves its own dedicated episode. And I might keep that for next week, because the implications are enormous and need to be unpacked carefully. But putting all of this together, the full scale of this shock has not been priced into markets, not even close. There has been only a minimal reflection of this reality in current prices. An oil price spike can materialize at any time. When it does, it will send shockwaves through global markets, amplifying the liquidity crisis and forcing the cascading liquidation of other assets as margin calls are triggered by the volatility. This is what the implied volatility of oil priced by traders has been screaming for weeks now. To wrap up, the situation is deeply messy. You cannot trust most of what you read right now, but the real numbers are beginning to surface, and the shortages on the ground are now undeniable. The market reaction can ignite at any moment. With Q1 2026 now in its final days, be alert to significant window dressing from asset managers, banks, and financial institutions of every kind, all scrambling to put as much lipstick as possible on their books, buy themselves more time before the true impact of this war begins appearing in their financial statements. The reckoning, I believe, is inevitable, and it starts next quarter. Thanks so much for listening to today's Cigar Time, for supporting me on X and Instagram, and for reading my research at JustDario.com. Have a great weekend, everyone.